Hello and welcome to Omni Deep Dive. We explore any topic from finance and technology to literature and science. Sit back, focus, and get ready to dive deep.
Welcome to the Deep Dive. Our mission is always to deliver the core knowledge you need, and today we're tackling what might just be the single most essential book in modern finance.
It's a big one. We're doing a deep dive into Burton Malkiel's classic text, A Random Walk Down Wall Street, and we're using the updated 50th anniversary edition.
And Malkiel is, he's the perfect guy for this. He's not just an academic.
Not at all. He's been a market professional, a director at investment companies. He's seen it all for over half a century. And this book, with millions of copies sold, it's not just theory, it's really a historical indictment of speculation and a practical roadmap for actually succeeding.
Right. So our goal for you today is a deep extraction. We want to pull out the fundamental, often counterintuitive lessons about efficient markets, about bubbles, and the strategy that really works over the long haul.
And we should be clear from the start. This is, as the book says, the get rich slowly but surely book.
Slowly but surely, because you are in a constant, brutal fight against inflation just to keep what you have.
It's a vicious fight. Malkiel lays out the numbers, and they're sobering. Between 1962 and 2021, the consumer price index shot up over 800%.
Wow. What does that even look like in real life?
Think of it this way. The price of a Hershey bar went up 1,900% in that same time. So if your investment strategy is netting you 5%, but inflation is 3%, you're barely treading water.
So you need a real strategy. And to get there, we have to start with the two competing theories of value that Malkiel presents. Because one of them is, well, it's financially lethal.
Right. First, you have the firm foundation theory. This is the rational textbook idea. A stock has an intrinsic value, based on its future earnings, its dividends, the actual cash it generates.
That's the Graham and Dodd sensible investing approach.
Exactly. But then you have the other one, the one that's way more exciting, way more dangerous, and culturally dominant. The castle in the air theory.
Okay, what's that?
This theory just assumes a stock is only worth whatever the next person, the greater fool, is willing to pay for it. It has nothing to do with fundamentals. It's all about mass psychology.
And spotting who's going to be the next fool.
And getting out before you are. And history, well, history shows that the castle theory is often in complete command, leading to these insane cycles of speculation.
So let's look at that history. Malkiel starts with, I think, the granddaddy of them all. The tulip bulb craze in 17th century Holland.
Yeah, this started in 1593. And what's fascinating isn't just that people paid a fortune for a flower bulb. It's how sophisticated the speculation got.
It wasn't just people trading actual tulips.
No. They were using complex financial instruments, specifically call options. This gave them massive leverage. You could put down, say, 20 guilders to control a bulb worth 100. If the price doubled, your money just quadrupled.
So that leverage just poured gasoline on the fire?
It absolutely did, until the whole thing collapsed, of course.
Right.
And the bulbs ended up selling for literally the price of a common onion.
A century later, it happens again. England, the South Sea Bubble.
Same blueprint. The company had a trade monopoly, but the directors, they didn't care about trade. They cared about hype and fraud.
And this is where we get that absolutely absurd example from the book.
Oh, it's my favorite. A promoter put out a prospectus for a company for carrying on an undertaking of great advantage, but nobody to know what it is.
And people invested.
He sold shares to 1,000 people in 5 hours. Then he vanished.
That is the perfect definition of the castle in the air theory.
It is. You're not investing in a business. You're investing in the hope that a greater fool exists. And it ruined fortunes, including Sir Isaac Newton's. He lost a ton and famously said, "I can calculate the motions of heavenly bodies, but not the madness of people."
If Newton couldn't figure it out, what chance do the rest of us have?
Right. Now, fast forward to the 1920s crash. Variety had that great headline, "Wall Street lays an egg." Here, the manipulation got very organized with these investment pools.
How did those work?
Well, the managers would buy up a stock, use their insider connections, and then start doing wash sales, basically trading shares back and forth among themselves.
To make it look like there was huge interest in volume.
Exactly. The ticker tape would go crazy, the public would pile in, and then the insiders would quietly sell out at the top. It was a fleece job.
And the corruption went all the way to the top. The example of Albert Wiggin, the head of Chase Bank.
It's incredible. He personally sold short over 42,000 shares of his own bank stock right before the crash. He made millions while the country was ruined.
The devastation was just total. Blue chips lost 95% of their value.
The lesson there is just so clear. Sharply rising prices are almost never, ever followed by a nice, stable plateau. They're followed by a cliff.
Okay, so if the crowd gets crushed in these manias, what about the experts, the professionals? Surely they can navigate this, right? Which brings us to Malkiel's big critique of active management.
He starts with the chartists, the technical analysts.
Their belief is that everything you need to know is already in the price chart, that prices move in predictable trends.
Right. This is what's known as the weak form of the efficient market hypothesis. But Malkiel's conclusion, after looking at decades of data, is that it's just false. Past price movements cannot reliably predict future ones. The market, he says, behaves like a random walk.
But hold on, what about momentum trading? That's hugely popular now, especially with tech stocks. Doesn't that sort of contradict the whole random walk idea?
That is the big challenge to the theory, yes. But Malkiel's point is that even if these small temporary trends do exist, they are almost impossible to time reliably. And the danger of trying is catastrophic.
Why?
Because one study found that 95% of all the big market gains over 30 years happened on just 90 trading days.
90 days out of thousands.
Out of 7,500 trading days. If you miss those 90 days, your returns are just decimated.
Yeah.
And no indicator, not the hemline indicator, not even the Super Bowl indicator.
Which, as he notes, is outperformed by butter production in Bangladesh.
Right. None of them can find those days for you.
Okay, so technical analysis is out. What about fundamental analysis? The Graham and Dodd way. Visiting companies, predicting earnings.
That picture is just as grim, honestly. Security analysts' forecasts often do worse than really simple, naive models.
Why is that?
Because, as he says, analysts can't predict consistent long-run growth because it does not exist. I mean, just look at the corporate graveyard. IBM, Kodak, GE. These were seen as untouchable titans. All of them hit a wall.
And then there's the even more uncomfortable part, the conflicts of interest.
Huge conflicts. Analysts were often just salespeople, paid to be bullish to win lucrative investment banking business for their firms.
The numbers on that are just damning.
They're staggering. During the dot-com bubble, the ratio of buy-to-sell recommendations hit 100 to 1. 100 buys for every one sell. And studies showed that the strong buy stocks from firms with banking ties actually underperformed the market.
So they were actively pushing bad investments.
They were incentivized to. It wasn't about being right, it was about generating fees.
So if even the professionals fail, let's look at more modern manias where big institutions got involved, like the Nifty 50 in the 60s and 70s.
This was a huge one. Institutions got convinced that these 50 large-cap stocks were one-decision stocks. You just buy them and hold forever.
Companies like Polaroid and McDonald's.
Yeah, trading at 80 or 90 times earnings. They just threw valuation out the window, believing that size and reputation made them immune to gravity. It's really the ultimate proof that stupidity, when it's packaged well, can sound like wisdom.
This era also gave us some pretty creative accounting, the conglomerate boom.
Oh, the financial ledger domain, as Malkiel calls it. It was basically an accounting trick. A company with a high PE ratio would go and buy a company with a low PE ratio.
And the combined company looked like it was growing faster.
Exactly. Even if neither company grew its sales by a single dollar, the combined earnings per share would magically go up. It was pure statistical illusion.
And that kind of illusion can pave the way for outright fraud, like ZZZZ Best.
Barry Minko, a complete textbook case from the 80s. He convinced everyone his carpet cleaning company was the General Motors of carpet cleaning. The stock went to over 100 times earnings.
And the whole thing was fake.
A total Ponzi scheme. Fictitious contracts, money laundering, the works. It just shows that no matter the era, speculative greed finds a way.
Which brings us to behavioral finance. Because if markets aren't perfectly rational, maybe it's because we aren't.
That's the whole argument. Behavioralists say markets aren't efficient because arbitrage is risky and, more importantly, investors are predictably irrational. Our brains just aren't wired for this stuff.
Take overconfidence.
A classic. Studies show 80 to 90% of us think we're better than average drivers. It's called the Lake Wobegon effect. And that same bias makes investors trade way too much, thinking they can beat the market.
And that couples with the illusion of control, the idea that you can see the trend, that you can get out before the crash.
Exactly. They've done experiments where people think they can influence a coin toss if they've had a winning streak. It makes us see patterns where none exist, which is a disaster for investing.
And maybe the biggest one of all is loss aversion.
This one is so powerful. We are psychologically wired to avoid a sure loss, even if it means taking a bigger risk. If you offer people a choice between a guaranteed loss of $750 or a 75% chance to lose $1,000, most people will take the gamble.
And that's why they hold on to losing stocks.
Yes, they can't stand to make the paper loss real by selling. But a paper loss is just as real as a realized one, and holding on to a dud like Enron stops you from taking that tax loss and putting the money to better use.
We've seen all of this play out again recently. I mean, first with the meme stocks like GameStop.
GME was, as Malkiel puts it, an epically insane rise and fall. It had this David and Goliath narrative, right? Squeezing the hedge funds.
Right. The stock flew from $17 to almost $400 in January 2021.
But for every dollar taken from a hedge fund, much, much more was just transferred from one overconfident individual trader to another. And the end results were tragic. We saw reports of traders taking their own lives over the losses.
And then, of course, cryptocurrencies.
You know, the underlying blockchain technology is a real innovation. But the price action of something like Bitcoin, from pennies to nearly $69,000, that is the very definition of a speculative bubble.
It's pure castle in the air.
100%. The price is based solely on the belief that someone else will pay more later. We even saw mini bubbles, like SPACs.
Which are just the modern version of that company for doing nobody knows what.
Exactly. A blank check. And NFTs, I mean, Jack Dorsey's first tweet selling for $3 million. It's tulip bulbs for the 21st century.
So after all this history of failure, what's the actual practical guide? If picking winners is a loser's game, the solution has to be something else.
The solution is indexing and diversification. It's the no-brainer step.
And the proof is in the numbers.
The proof is overwhelming. Malkiel gives this incredible comparison. An investor who just bought a broad index fund in 1977 had over $2.1 million by 2022.
Okay, and what about the person who tried to beat the market with an actively managed fund?
That person had about $1.47 million. The difference is a staggering $666,467.
Wow. Just from choosing the simple, boring option.
It all comes down to one thing. Costs matter most. The fund industry is the one place where you get what you don't pay for. Low fees are the single best predictor of your actual net returns, period.
And the other half of that is diversification.
It's the only free lunch in finance. You can slash your risk by over 60% just by owning around 50 well-diversified U.S. stocks. But for true optimization, you have to go global. Historically, a mix of about 82% U.S. and 18% foreign stocks gave you the best risk-adjusted returns.
And this is so crucial. Avoid concentration risk. The story of Carl P. in the book is just heartbreaking.
It really is. He was a foreman at GM. His entire retirement portfolio, $219,000, was in GM stock. When GM went bankrupt in 2009, he lost his job and his entire life savings on the same day.
The lesson being,
never, ever take on the same risks in your portfolio that are already tied to your main source of income.
Right. And for those of us in or near retirement, Malkiel has updated his thinking on how much you can safely withdraw.
Yeah, the old 4% rule is a bit outdated now with lower interest rates. He now recommends the 3.5% solution. It's more conservative, but it makes it much more likely your assets will last.
What about all the new fancy strategies? Smart beta, risk parity. Should we be paying attention to those?
They're interesting for sure. They try to systematically capture factors like value or momentum, but Malkiel's core finding still holds up. For most people, a simple, broad-based index fund should be the core of everything. The extra complexity rarely pays off.
So the immutable lesson at the end of the day
is that superior returns come from taking on appropriate, broad market risk over time, not from market timing or stock picking. He says, avoiding horrendous mistakes is probably the most important factor in preserving one's capital.
So let's recap the final rules. Index the core of your portfolio.
Diversify broadly, and make sure that includes internationally.
Minimize your taxes using things like tax loss harvesting.
And above all, be absolutely ruthless about controlling your investment costs. Even Warren Buffett, the greatest active manager ever, said in his will that his estate should be invested in index funds.
That says it all, doesn't it?
It really does. So if this entire deep dive convinces you that the stock market is essentially a loser's game where you win by not losing, then we leave you with this final thought to take away.
Of all the psychological biases we discussed today, overconfidence, the illusion of control, loss aversion, which single one do you need to actively police in your own investing behavior starting today?
That wraps up this Omni Deep Dive episode. Thank you for listening. If you found value in today's deep dive, please click like and subscribe to our channel. Take care.